just on my whole introduction on mute. We did say this was going to be an informal session, so thanks everyone for joining. This is week 2 of a month of Kepler events. This week we're looking at investing for income, and I'm really pleased that Zenah from JPMorgan has joined us today. Zenah's an 18-year veteran at JPMorgan, and she's part of the fund management team that looks after JPMorgan European Growth and Income Trust. And I think, given that European equities were very much out of favour with institutional investors in particular last year, and with a backdrop of rising interest rates, inflation and energy prices, this could be a pretty interesting time to take a fresh look at European equities. And so JPMorgan European is particularly interesting, we think, because it's both JPMorgan's core European equity offering, but it also uses the investment trust structure to provide investors with an income which is calculated at the end of every March as 4% of net asset value, which is paid in 4 installments. So you get the best of growth and you get the best of income. And so with that brief intro, I'll hand over to Zenah. Before I do hand over, I should say, please put any questions you have into the Q&A box, and Zenah will present for about 30 minutes, and then we'll come to some of your questions after that. There'll be about 15 minutes for Qs after the presentation. With that, Zenah, over to you.
Brilliant. Thanks, Alan. I did have a panic there where I was like, I can't hear Alan. Good afternoon, everyone. I'm glad you can hear me. I'm really looking forward to being here with you today to help you make some decisions for your ISA. And given that ISA season sounds like an opportune time, I'm Zenah Shuhaiber. I'm co-manager on the JPMorgan European and Growth Investment Trust. And hopefully by the end of this session, I hope that you can take away the 3 following conclusions. So firstly, Europe is a really interesting market for this cycle and could really help you with some of the diversification of your investment allocations. Secondly, our approach to investing allows you to get the best out of both growth and income, as Alan just mentioned, and we do this via a very well-balanced core portfolio. And then finally, we'll also take a look at some of the performance drivers of the recent years and also how we're positioned today. So without further ado, let's get started. Let's figure out how to change these slides. There we go, I got it. So Europe, it's definitely been ugly, we know that. But we really have to question ourselves in terms of thinking, has it really been that bad? And also, what does all of that mean for the stock market? So we've seen a lot of unpleasant headlines over the last year or so. There's been a war on our doorstep, which has been very difficult to absorb from a humanitarian perspective. For instance, it's also put significant pressure on our source of energy, sending gas prices in a very upward spiral. The inflation that was meant to be transient showed signs that it was actually not so transient. And then COVID lockdowns in China kind of became the norm. And it's really difficult not to mention the rising cost of living and the pressure that that's had on all of us. And really where we come in is, we think that this left us all feeling a little bit like this. And let's have a look in more detail as to why. So the chart on the left-hand side shows some Eurozone inflation data. We hadn't seen this level of inflation for decades. And many of us haven't even lived through that level of inflation, or at least not as adults. And it's been really, really widespread. So the annual increase in the cost of food, alcohol, tobacco, that went up 13% in a year at some point last year. In the UK, for instance, we all experienced, milk rising by 40%, ham rising by 30%, the price of butter going up by 20%. These are all really, really big numbers. The amount we used to spend to fill up our car would only get us kind of 2/3 of the way there now. And of course, the energy costs in our households just ballooned. And we're certainly seeing some of that come down, but in many parts of the world, inflation still remains high, and it's something that we still need to be cognizant about. And what impact does this have on the consumer? Well, their confidence dropped to lows that we hadn't seen since the global financial crisis, and that's understandable. Real wages were pressured, obviously, as inflation went up. The cost of living rose, and this was obviously a very, very difficult time. But this is where we need to question now, is it really, really that bad? And one of the key things that we've been watching has been the level of gas inventories in Europe. And I have to say that this looks really, really impressive. Now, part of that has been driven by weather, and obviously I know that we've been really freezing in the UK, but life on the continent has actually had a very pleasant / mild winter, depending on who you ask. And that has meant that obviously the demand for heating hasn't been as high as usual. We've also seen the industry, so in more industrial related companies, also lower demand, in part as a function of, obviously it was higher cost for them, but also because a lot of the switching mechanisms that they had in place was still in place. So a few years ago, when everyone realized that oil was, high carbon intensity for a lot of their businesses, and they were trying to bring that down, they built out these gas sort of units and switched to sources of gas for a lot of their industry. But that didn't mean that they shut down the oil side of things. So obviously they were able to do some switching from that perspective. And also there was a lot of imports coming in from US LNG. And so when we look at the chart on the left-hand side of this, on this chart, gas storage in Europe is actually much, much fuller than usual for this time of year, and that is really good news. So let's have a look also at earnings, because at the end of the day, it's really the growth in earnings that drives stock markets. We have seen a strong recovery in earnings since the pandemic. It's actually quite remarkable that during this period, companies continue to surpass expectations from a consensus perspective, and continue to surprise on the upside in terms of the earnings that were coming through. And thinking about some of the phenomenon that would have caused this, inflation is actually good for companies with pricing power. And we can get to hear some examples of that a little bit later. Another tailwind for earnings could be the reopening in China, and in particular for Europe, that could be quite meaningful, because the revenues coming from European companies are quite heavily geared into Asia and China in general, and geared into sort of export data. And so that recovery that we might be able to see in China could drive further demand for European companies' goods and services. And then as a final point to just conclude some of these more macro observations, is that we have to look at valuations as well. 2022 was a difficult year from a returns perspective for many sectors, with the exception, of course, of energy. But with resilient earnings that we've just discussed, this made markets actually look quite attractive from a valuation perspective. And this, in the context of history, is very interesting from a European standpoint on an absolute basis, but it's also quite interesting when we compare it against other asset classes as well. So if you take the US equity market, for instance, this pan-European benchmarks are currently trading at a 30% discount to the US. And we haven't seen that level of discount in over 30 years, which makes it a really compelling entry point into the long-term future of European equities. So we can move on to the investment approach now. And if you're looking for a way to get invested in European assets, then this could be a good solution for you. I should also put it out there that the trust is currently on an 11% discount to NAV, which means that actually you can buy European assets for even cheaper. So there are three key things that I would like you to take away from our investment approach. So firstly, you're all here to learn about income opportunities. The trust structure allows us to do just that. We are able to provide our investors with a 4% dividend yield, which is set at the beginning of the fiscal year, without actually impacting the way we manage the portfolio, so our stock selection and the way we build the portfolio as a whole. And this is what we mean by growth in income without compromise. Secondly, our long-term performance track record that you can see on the right-hand side has been very good. And many of you might understandably be concerned with, is this a value market? Is this a growth market? And that's, perfectly acceptable given the market that we've been in. But our track record actually suggests that it actually doesn't matter when you invest in a strategy like ours, because we can actually outperform the benchmark in both of these environments. And then finally, we do this by building a portfolio that is well balanced. It is a core portfolio. And we know that our core competence is in stock selection. That's where the bulk of our resources come from. And we use a lot of portfolio construction tools in terms of managing the risks of the portfolio and making sure that the portfolio as a whole is quite well balanced. So let's go into a little bit of how we actually manage the portfolio. Our process really harnesses the best of both quantitative investment on the one hand, but also fundamental analysis. And by doing this, we really think that we can be able to sort of target our objectives. And we know that there are both pros and cons to each of these, which is really why we believe that the combination of the two is a really powerful one. So I like to think of this, for instance, as man in the machine. So there's always good things that you can do with your computer, but at the end of the day, there's really no substitute for common sense. Quantitative analysis, for instance, is really good at examining a lot of data in one go. It can be very consistent. It can have a large breadth of coverage. And that's also very important for our strategy as well, in terms of being able to sort of access some of the smaller mid-cap areas of the market. Fundamental analysis, on the other hand, it's a lot better at sort of dealing with data poor environments, recognizing where we might actually be entering an environment that is changing. If you take something like a stock example or a sector example, within healthcare, there can be pipelines of drugs with a lot of trials coming up, and a lot of those issues can be binary for a company's fundamentals. So something like that, quantitative model will not as easily pick up, and you really need sort of the fundamental analysis, and we'll draw upon our fundamental research analysts for something like that. And ultimately, we're using this combination of both the quantitative side as well as the fundamental side through stock selection, portfolio construction, as well as portfolio implementation. And what we end up with is this core product, which is quite diversified across stocks, across styles, across sectors, and across countries. So let's have a look at some of the stock selection that we do, and what we consider as sort of good attributes to have from a stock perspective. So we ask ourselves these 4 questions that you see in front of you. In reality, obviously, who doesn't look at these things? They actually look quite obvious. But really what it comes down to is the how. Like, how do we actually do this? So we're not just about, walking into a meeting as many CEOs that we can possibly meet and kind of sitting through an interesting meeting. And quite frankly, they are all very interesting. What we're really looking for is the hard evidence to support our investment thesis. And that's really where things on the quantitative side of of investing keeps us honest, keeps us genuine, and keeps this process quite rigorous. So let's go through each of these to just kind of give you a flavor of what we're actually looking for. So for instance, is it a good business? So over here, what we're looking for is thinking about measures such as profitability. So we're looking at things like the return on invested capital of a business. We're also looking at how sustainable those earnings are. So for instance, how much do they actually fluctuate through time? How much do they fluctuate through cycles? Because that really gives us an understanding about, how sustainable this business is. We'll also think about things like the capital discipline from a company's perspective, and how active, for instance, is the company at making those capital allocation decisions between M&A, between spending CapEx, between share buybacks, or paying out dividends. For the second one, valuation. Now, this is really, really important in markets. It has been important for a very long time. But a lot of investors didn't spend perhaps a lot of time on it in the last sort of 5 years as interest rates effectively went to zero. We've always been quite disciplined in our approach, and we've continued to look at metrics such as price to earnings, such as free cash flow yield. And it's really been that in particular that has helped our performance over the last sort of year and a half or so. As a third one, is the outlook improving? Over here, we're looking at a couple things. We're thinking about the earnings momentum of a company, and we're thinking about the actual share price. So is the share price doing well? And by looking at those two things, companies that tend to do well today actually continue to do well. And the converse is also true. So companies that are doing poorly kind of continue to do poorly. And then finally, as the last question, is the business sustainable? Obviously, ESG has come into the forefront of a lot of investing. I mean, it's important to know that this isn't an ESG fund, but we do think about the E, S, and G from both a quantitative as well as fundamental perspective as well. And it's really important to do that in terms of helping us identify winners and also managing downside risks. And we're really focused here on the financial materiality of what that means for any particular company. So these 4 characteristics, value, quality, momentum, and the ESG aspect, are the key attributes that we focus on at the stock level, but also when we think about the way that we construct the portfolio as a whole. So I also wanted to give you a flavor of some of the stocks that we can get access to via our investment process. Investing in European equities isn't just about the European macro, but really it's about the underlying drivers for the companies within our universe. And our universe today has access to growing companies with some long-term stable themes, and it's actually can be very, very exciting. I'll start with a slightly less exciting one from a sort of personal perspective, which is the interest rate normalization. And the reason I say that is because, of course, we've all seen the headlines around about mortgages going up. And that's a function of obviously the Bank of England raising interest rates. And that's something that is happening in Europe as well. And while it can be a little bit painful to some, with rates finally above zero, this actually means that banks can start to make money again. And coupled with their sort of low valuations, that makes them very good investment opportunities. Secondly, as populations age globally, we think European stocks can also be quite posed to benefit from this. One example, for instance, on the slide is UBS, which manages savings. Healthcare is also an important sector within European equities. The benchmarks are actually quite over-indexed to companies within the healthcare space. Novo Nordisk, for instance, is a high-quality company targeting solutions in obesity and diabetes. In fact, this is the company that is behind the once-weekly injections to combat obesity, which is much lower risk than, thinking about things like a surgical procedure. And it's now available via prescriptions at UK pharmacies, which makes it a lot more accessible to many more people. The low carbon transition, this has been front and center on the political agenda for the last 5 years or so, I would say, in Europe. European companies have had to respond in many areas and are market leaders in their field. Prysmian, for instance, it does a lot of the world's sort of largest cables. And it's very well positioned to benefit from the trends of electrification, of grid modernization, and just the renewable growth in general. And I think Europe's agenda really took off last year after the start of the war in Eastern Europe, as energy security became a concern. But now we're also seeing other countries, other continents also kind of take this a little bit more seriously for very many different reasons. So the US, for instance, introducing the Inflation Reduction Act, which many European companies are actually likely to benefit from, given that they actually have the know-how. E-commerce, another growing trend, it really kicked off during the pandemic. I'm sure a lot of us were buying online, whether it was supermarket, whether it was online shopping. Deutsche Post, for instance, operates DHL, and within that, their express business is basically known as their crown jewel. And then finally, there's the aspiring consumer, and luxury products fits right into this. And again, many stocks to choose from within the European benchmark. This sector has been growing for many years. And what's interesting about it is that it has such strong pricing power from the brands that it lends itself to being such a great inflation hedge as well. And then this year, we're getting this other kicker as well, which is the reopening of China and the amount of kind of pent-up demand. A lot of Chinese are likely to be traveling abroad, perhaps coming to Europe, spending more of their money in terms of, buying up some of these luxury goods in the shops. So far, we've focused a lot on the European macro, and we've taken you through our investment approach. I think for the next part of this presentation, we can also have a look at performance as well as how we're positioned. So let's have a look at performance, initially at the longer term performance. Europe, despite all the headlines that we've seen over the last decade, has actually performed very well. In fact, if you had invested your money in European equities 10 years ago, you would have more than doubled your money. And to be more precise about that, you would have had a 125% return. Through our investment process, over the same time period, your return would have been 165%, a 40% difference. That's the power of active management and of consistently outperforming, and that kind of compounds over time. So if we have a look at some of the shorter term performance changes. So for those of you not familiar with performance attribution, that's what we're looking at on this slide here. And it's a way of basically dissecting where that performance has come from, both at the sector level, but also at the stock level. So for instance, on the left-hand side, you can see that we were underweight real estate, so that you would refer to being underweight real estate. And that was actually quite positive for us over the last year. Likewise for something like healthcare equipment and services, whereas the yellow denotes that that's where our stock selection came from. So that was quite positive, for instance, in utilities as well as pharma and biotech. And then on some of the detractors, the overweight within semiconductors, for instance, was more of a challenge for the portfolio. On the right-hand side, we can see how we can look at more sort of at the stock level, what worked and what didn't work. And over here, we've obviously just limited it to the top fives, just to give you more of a color of what has been working. So Novo Nordisk, for instance, we mentioned it just a few minutes ago. The stock is the one that manufactures drugs for obesity and diabetes. The stock has performed well So that would have been one of our main contributors over the last year. We also own UniCredit, which is an Italian bank. It almost doubled in the last year. And this is an example, for instance, of those banks that are benefiting from rising interest rates, but also has really strengthened their balance sheet, taken on a lot of provisions, which the market is, finally giving it credit for. And, of course, we don't always get everything right. That's also comes with fund management. And on the bottom half, there are some examples of stocks that we didn't get right. I mentioned semiconductors earlier. One example of that would be ASML Holding, which is a Dutch company. It's in a very unique position. It actually manufactures the machines that semiconductor companies then need in order to make the semiconductors. It pretty much operates in a very sort of monopolistic market environment. In hindsight, the valuations had gotten high last year and the stock derated. But we still really like the long-term story, and this is the stock that we continue to hold in the portfolio. So we can have a look at some positioning data now and some of the portfolio changes that we've made. If you've been keeping up with some of our materials from previous forums, we were positioned quite defensively in 2022. And one of the main themes over the most recent months was tempering some of that defensive position in the portfolio. And the stocks are always selected on a bottom-up basis. But I think this slide basically shows quite clearly that on the left-hand side, a lot of the purchases had been in more cyclical sectors such as capital goods, software and services, and retailing, whereas some of the sales were in more defensive sectors. We can talk about how we're positioned today as a result of those changes, but in a nutshell, the portfolio is a lot more well balanced, I would say. So it doesn't necessarily have, either a cyclical or defensive bias. Just as an example from some of these sectors where we've liked some of the stocks. Within cap goods, we've purchased a stock called Andritz. It's an Austrian company. It makes machinery to very many sectors. In particular, for instance, the hydropower sector. And last year, they were seeing their order backlogs rise, and rise quite consistently, actually. And this happened across many of their businesses. And so for us, that was a good signal in terms of some of the earnings upgrades that it was seeing in terms of initiating a position. And then on the right-hand side, you can see some of the sales that we've done. Telecoms was one of the bigger sectors where we sold some of those stocks. And this was stocks like Orange and Telefonica. The sort of overarching theme within telcos is, one, they're quite highly levered. So with rates going up, of course, their cost of debt becomes higher. And then secondly, their costs were going up in general, just as all of our costs were going. But actually, there's quite a lot of competition in the market, so they couldn't push up their prices higher. So, if you're like me, I only just got, an email from EE telling me that my phone bill is going to go up, but they weren't really able to do that last year, and it's kind of almost sort of a year late. So their margins have already been squeezed in the meantime. So if we have a look at how we're positioned today, this basically shows the top 5 and bottom 5 actives across sectors. I don't want to spend too much time on this slide. I think the important thing to note here is that we don't necessarily take big bets at the sector level. So I guess with that in mind, it's probably best to turn to the next page where we can see some of our top 10 and bottom 10 actives. And I think it could be interesting to do this, for instance, from a intra-sector perspective. So Novo Nordisk, we've already discussed a couple times, so I probably won't touch on that at the moment. But on the other hand, we're underweight Sanofi. This is a company that's exposed to many diseases such as cardiovascular, thrombosis, oncology. But we've been more concerned around the productivity around some of their research and development in order to secure a more positive pipeline for the future. Within consumer staples, we like Ahold on the left-hand side, while we're underweight Anheuser-Busch on the right-hand side. Ahold is one of the better quality food retailers with a big exposure to the US market. they've really demonstrated their ability to pass through the costs in this environment, and as a result have seen sort of a sequence of earnings upgrades, whereas on the flip side, Anheuser-Busch has really struggled with volumes, and that was really a global phenomenon. And then just maybe one more example from this slide is that within luxury. So we noted earlier that luxury was a very long-term trend, and Europe actually has a lot of good companies in terms of choosing from. And one of those today is LVMH, where we've continued to see very strong demand for their product. But not all luxury companies execute well at all times, and we have to bear that in mind. And that's where really the sort of bottom-up stock selection comes from. So Kering, for instance, on the right-hand side, it's home to brands such as Gucci and Balenciaga. They've had a couple missteps. Gucci, I think they're trying to work through what their brand actually means. Balenciaga, you may have seen in the headlines towards the end of last year, they had a sort of big campaign issue. So we really need to see signs of improvement before we can get behind stock like that. And then finally, just to kind of conclude in looking at the entire portfolio, we've talked a lot about the individual stocks and how we get around that. I think the one key thing to really know about the portfolio is that it's very diversified across a number of things. So whether we look at number of holdings, whether we look at the geographical breakdown of where the revenues come from and the underlying companies, and also when we look at the style. And really the one thing that we kind of want to leave you with is that the portfolio is not necessarily just a collection of our best ideas. We also take into account the portfolio risk and understanding how all of those good ideas kind of fit within the context of a portfolio. So just finally, in the interest of time, just the final slide here. I mean, effectively, it's just sort of a, just to conclude in terms of, you know, what we've discussed today. We've talked about why Europe isn't really all that bad, despite some of the headlines that we've seen. The unique approach that we take within this trust in terms of managing clients' money, and also just giving you some context in terms of the performance and some of our positioning. I hope you found this presentation useful, and I'm happy to take any questions that you might have.
That's great. Thanks. Thanks so much, Zenah. And we do have quite a few questions, which I'll try and pull into. Yeah, there's a sort of some common themes that have come across. The first one is you talked a little bit about energy prices, and first of all, what's JPMorgan's outlook for energy prices, and what's the kind of impact of that outlook or likely to be on economies and markets? And then sort of weaving into that, you know, rising energy prices may well create opportunities, and you mentioned some of your energy transition exposure. So have you got some examples where traditional energy prices rising has created opportunities elsewhere?
Yeah, absolutely. I mean, we discussed before in terms of some of those commodity prices coming down. So I think that that the near-term outlook for a commodity such as natural gas, for instance, is a little bit more positive than we had been over the last 12 months or so. I think the world probably is still kind of undersupplied in terms of some of these resources, but it really is about how fast we can get to building out some of those renewable projects. And Europe actually houses a lot of companies that we can see from that perspective and taking advantage of some of those trends. A sort of classic sector, and you know, one of the more important sectors is within the utilities segment. They're actually transitioning a lot of their plants into becoming a lot more renewable. Companies such as RWE in Germany, they're getting rid of some of their coal assets and really investing quite heavily in the space. And likewise, Iberdrola which is a Spanish utility, is also quite linked to the sector. And then I spoke a little bit about sort of the rest of the supply chain as well, which is really important. So we can think of something like a Prysmian, which actually provides, the cables that go into all of these electricity grids. Schneider Electric is another great example. Very high quality stock, very, very well diversified across all regions, which means that a lot of this can actually be transferred into the US, into Asia. But effectively what they do is a lot of the energy management systems. So they help companies understand the energy that they're utilizing, the carbon that they're offsetting, and help them manage, how do you optimize that? How do you get that to a lower stage? So there's many companies within Europe that are quite market leading within this space. And I think that, as sort of the rest of the world kind of, builds out some of these political agendas, they will be on many of the sort of, bids and winning bids that a lot of these projects have to offer.
Yeah, I think Schneider Electric also does the Wi-Fi valves on my radiators, just to bring it to the domestic. There's a few different questions about, this is a core mandate, isn't it? So I think it's quite good to talk, and you have covered some of your attribution and relative positions, but there's a few different questions essentially around risk. And if I can tie that together, the kind of standard sector and geography and stock limits that you have, and I think it probably makes sense to tie in gearing with that. So what's your gearing range, and also I think it's probably worth briefly mentioning how the trust is geared. So I think it's done a pretty good deal on interest rates, hasn't it? Which will benefit shareholders. So
Sure. I mean, to take the initial question in terms of some of the constraints that we put on the portfolio, you're absolutely right. So we think that our core competence is within stock selection, but we definitely take into account a lot of the other risks, and we actually want to minimize those risks in order for the stock selection to speak the most loudly, let's say. So some of those constraints that we have is stocks are limited to 2% active positions, both in terms of the overweights and underweight. We also have limitations around sector and country. So at the sector and country level, we're officially at sort of 5% on the active side, but in practice, I think we stick to around sort of the 3% mark. So we don't actually take very big bets at the kind of country and sector level at all. Then in terms of gearing and our approach to gearing, I think within the context of trying to build a core portfolio, that's really where some of the thinking around gearing came from. Longer term, we think markets go up. So I think it's fantastic that we are able to add gearing to this trust, and we would like to see ourselves sort of in a long-term position to be positively geared to the markets. But equally, we think about that our core competence isn't timing the market, so that's so we need to be careful in terms of taking big positions within that gearing. And secondly, think about it as a percentage of risk within the portfolio as well. So there's no point really having a core portfolio that's very well balanced and then being sort of sideswept by the risk that you're taking from the market risk. So we think of that within the context of what we're trying to deliver to our clients. And as a result, we kind of tend to be sort of within the sort of mid-single digit range at the gearing level. And we really kind of, the way that gets moved about is very much driven by the stock perspective. So if we find the stock interesting and we think it would be a good addition to the portfolio, then our gearing might go up a little bit. And the opposite is also true.
okay, and I'll just add the the debt facility on this trust is fixed at, I think it's 2.6 something to 2035, so you don't have any kind of near-term refinancing, and
no, and that cost of debt is actually quite low as well. So it's
yeah.
pretty good.
Yeah. So you've mentioned how you're somewhat agnostic about value and growth, and you also talked about how in the last 5 years low interest rates have perhaps driven some investors to take their eye off valuation, and I'm not sure if it's in this presentation, but in answering a couple of these questions it would be quite good to go through the kind of portfolio characteristics that you show, like the return on invested capital and prospective growth. I think they're quite indicative of how the portfolio is constructed, linking that to the portfolio limits and so forth.
Yeah, absolutely. So, I mean, ultimately, as part of our portfolio construction, when we thought about, those 4 questions at the very beginning that we went through, it ultimately means that we're trying to be overweight value characteristics, quality characteristics, as well as momentum characteristics at all times. And that really gives us another kind of aspect of this diversification that we're targeting. So if we look at the bottom left-hand side of this slide, for instance, the benchmark is at around 12.5 times, and we like to be cheaper than the benchmark. So we currently are at 11.3 times. Similarly for quality, the benchmark is at around 13%, and we're targeting a higher quality measure, so 14.1% is where we currently are. And then as a proxy for momentum, in terms of looking at earnings revisions, we have faster growing earnings, or earnings revisions being higher than the benchmark. And ultimately, when we think about it, like we think about the portfolio as a whole really looking like it's the perfect stock. So it's the portfolio as a whole that is going to answer yes to all of those questions that we asked at the very beginning.
Mm-hmm. And then just with one eye on the time, do you want to talk a little bit about JPMorgan's ESG team and how sustainability is woven in? I mean, you have mentioned it in the presentation, but it's probably worth touching on the resources around that.
Yeah, absolutely. So as I said at the start of the presentation, we'll look at things like we'll look at both strands of investing for all the questions that we ask, and one of those, of course, does revolve around the E, S, and G characteristics of a company. And over here, we're really focused on financial materiality, and what that means for a company's earnings, balance sheet, cash flows, etc. So within JPMorgan, we have built out a really strong sort of resource franchise using both of those strands. So our sustainable investment team is very much responsible for looking at different types of data, a lot of third-party data, a lot of data that they come up with themselves, to kind of help us fill in some of the quantitative things that we're looking for. And some of that can be very sort of industry specific, and some of it can be more generalist specific. So like carbon intensity, for instance, is something that is a lot more sort of generic, whereas maybe water usage might be linked towards certain industries more than others. And then on the fundamental side, we also use a lot of our fundamental analysts in terms of helping us assess the ESG characteristics of a company. They actually answer a 40 question questionnaire that looks at, and it's yes and no, so it's very sort of comparable across different stocks. And then on top of that, they also have a materiality framework. So, for instance, how important is this actually to this particular industry as well? And we really combine the two of those in terms of getting a really holistic, strong view from an ESG perspective. It doesn't end there, of course. It doesn't mean that just because something might not screen so well, we won't look at it. We'll always kind of look into it. We'll try and understand why. We'll try and bring in the company management, understand, what is driving that score and what are they doing about it. So if we can engage positively with the company, for instance, and RWE is a great example of that. It actually scores really poorly on ESG today because it has coal assets that it's looking to divest. And that was meant to happen much earlier, but with the conflict in Eastern Europe that happened, it actually was more responsible for them to keep it, given energy security to the rest of Europe and in particular Germany, than it was to just shut it down and get rid of it. So we'll talk to them about things like that and just assess whether that score is really the sort of ultimate defining score, or whether there are improvements that are being had at the company that still allow us to make good investments within from that perspective as well.
Great. I know we've overrun by a couple of minutes, but given that this is investing for income week, there is a couple of questions about dividends, so one of those, I think neither Kepler or JPMorgan can give tax advice, but there's a question about tax on the dividend. This is a UK investment trust. It pays its dividends like any other investment trust or UK company, and so there's no difference between the dividends that this company pays and any other UK company. Your individual tax position, you'd have to take advice on that. The other question is about dividend cover, and Zenah, and I think the précis is that the trust pays a dividend using reserves, and you as a fund manager aren't targeting income in particular, are you? So it's a kind of, the investors have certainty on the 31st of March about what the next 4 quarterly dividends will look like, and then that's reset each year. Is there anything else you want to add to that?
Yeah, I mean, I would just say that I think it's a great way of structuring it, actually, because if you just traced, for instance, the highest dividend paying stocks, they don't actually make always the best investments. Sometimes it's actually a negative sign in terms of a company in sort of huge distress. So for us, what this allows us to do is really focus on the portfolio, focus on what we know kind of works from a longer term perspective. But then our clients will still get that sort of guarantee of 4% yield. At the moment, we're not too far off in terms of what the portfolio's natural yield is. I think it's probably around 3.5%. So a little bit of that will come from capital, but hopefully with the growth of markets, then you kind of get that on top of the 4% as well.
Great. I think with that we'll close on things now. Thanks everyone for joining. It's been quite a lively Q&A session, so thanks Zenah for taking all of those questions, and
Thank you for having me.
And as ever, you know where to find us. If you have any further questions, just send Kepler an email, and the recording of this will be up on the website in due course. So good to see you, Zenah, and see you soon.
Too.
Thanks.
Thank you.